Lyn Alden is founder at Lyn Alden Investment Strategy. She's joining us right now to take some questions. Lyn, great to have you with us here on CNBC-TV18. Prashant this side. Now, just sort of your own framework. Everyone is kind of talking about whether what we saw early August is firmly behind us and we are once again back into more sort of trending up and up kind of markets. What's your sense, Lyn?
So first of all, thank you for having me. I think one of the major things to focus on is the upcoming Jackson Hole Symposium and some of the potential moves that the Fed could be making, because in addition to affecting U.S. markets, it can affect global markets. As you mentioned earlier in the program, the dollar index is a really strong variable for that. And the base case going forward that the market is pricing in is a number of gradual rate cuts in the quarters ahead, which should relieve burdens, especially for various markets that have a lot of dollar-denominated debt. That's one of the main mechanisms for that weaker dollar, or at least that like somewhat softer dollar, should be supportive. So I think we have to watch if there's going to be follow-through with those actions.
Lyn, hi, good morning. So do you see the environment continuing to be conducive for risk assets? Because I think everyone's agreeing that the Fed will cut. It's just a question of the pace and the timing. Is the worst of the yen-related volatility, is that behind us?
So I think we shouldn't expect the type of performance we got last week. I think we have to be a little bit more cautious after the rebound. I don't specialize in predicting very short-term moves. I think we're still probably going to see some periods of volatility. One of the things I'm tracking a lot is that I don't particularly think that the rate cuts we're going to expect in the U.S. are going to be very effective for the U.S. economy. So the U.S. economy is softening. A lot of the debt for both consumers and corporations is already locked in at fixed rates lower. And there's only some parts of the market that have, variable rate debts or other kind of high rate debt. And so I don't think 50 basis points or even 100 basis points is going to be particularly effective there. But I do think that could be meaningful for the dollar relative to other currencies. And so actually some of the areas that could get the biggest boost from a softer Fed are the emerging and frontier markets of the world. So that's kind of where I'm monitoring to see if that thesis plays out as expected.
Well, Lyn, if one's belief is that it's about when the US cuts rates and not if, do you think emerging markets would benefit? You don't see it doing much for the US economy on the whole, but if emerging markets were to benefit, if that's the thesis, then would it be India or would it be others because of the outperformance that India has already seen?
I think it'd be a number of them. It could very well be outside of India because India has less dollar-denominated debt as a percentage of GDP. So that particular variable is less impacted. There's more other factors that have been going on. Instead, I think we could see some kind of catch up from some of the emerging markets that have struggled as of late, particularly Latin America, for example, other parts of the world. And you can get kind of a virtuous cycle there. So there, when capital pulls out of emerging markets, it goes into the dollar and other kind of areas like that. It strengthens the dollar and therefore puts pressure on their debts. But when the dollar softens and eases their debt, it eases liquidity conditions in those types of economies, and then it can attract more foreign capital, which ironically can weaken the dollar further and strengthen those currencies a little bit further. The most useful comparison to be aware of is that kind of 2002 to 2007 period. After the U.S. Went through its dot-com bubble, we had a fairly mild recession in 2001. We cut rates, and that the biggest benefactors, I mean, the U.S. housing market did well, but the biggest benefactors were emerging markets for that next kind of 5-year period. And I think that we could see, maybe not to that extreme level, but I do think that we could see that kind of leadership, and that's the kind of rotation that I'm looking to see if that starts to confirm itself or not.
Lyn, do you look at emerging markets? Do you look at India at all? Any views here?
I do. I've been structurally bullish on the Indian stock market for years. Given the specific dollar focus and how we could get dollar relief from some of the markets that have not done well, I do think that there could be a period of time where, for example, Latin American equities have my attention at the moment because they're the ones that would potentially benefit the most from, say, the dollar index falling by a few hundred basis points. But I'm structurally bullish on India. I'm structurally bullish on more cyclically bullish, I would say, on parts of Latin America, as well as certain frontier markets, other parts of Southeast Asia.
All right, Lyn, we'll leave it there. Great conversation. Thank you very much for being here on CNBC TV 18. Appreciate your time here.